All right, so with the recent run-up in a lot of these chip stocks, I mean, more or less driven by the AI hype, I wanted to talk about what is, at this very moment, my top semiconductor company. Again, a lot of people, it's NVIDIA, it's AMD, whatever. And the problem with all of these companies is they're way too expensive, right? I mean, NVIDIA being exhibit A of that, right? So I have microchip technology, right? And there's several reasons why I have it as my best right now. So let's get right into it. I'll go over all the reasons. Again, this company has been around since, I believe, the 90s. Maybe, I don't know exactly when, but definitely before 2000. And in that time, it's been one of the top performing companies in the S&P. I believe in the top 10 or 20 over that time, right? So again, this is literally one of the best performing companies we've ever seen, for starters. And again, always outperform the market. But it's not talked about that much, and it really kind of boggles my mind on that one, right? Again, earnings yield of about 5%. That's higher than most comparable companies, right? Let's get into the insights here. Again, analysts are bullish. The dividend is, I'll talk about the dividend when I get to the dividend. Financial health is a little bit concerning, but again, you look at the growth here. Again, almost a perfect growth score, almost a perfect profitability score, almost a perfect return score. Again, just amazing numbers it's putting up there. Again, another very important thing here, price to free cash flow of 14, right? That is almost unheard of for a company that's growing as much as this company is, right? PE of 19, again, almost unheard of. Again, like 19, I believe that's actually pretty much what the market returns over the long run. And again, this is a company that's drastically outperformed the market over the long run, right? So again, in my mind, I think that this company is a steal of a deal, right? If you could get it for cheaper, that'd be even better, because that would be even better. But I think it's still a good price where it's at. And I mean, the numbers speak for themselves, right? Let's get into the financials here, because there's a lot of other good things in here. Let's look at the metrics here, right? And the most important things here is, if you look at gross margin, operating margin, EBITDA margin, net margin, free cash flow margin, and operating cash flow margin, those are all at all-time highs, and they've all consistently been going up since 2020, right? So again, very, very good there, right? Let's get into the actual cash flow statement here, because there's some things I wanted to bring up there. The first thing being, it's been paying down debt for the last 4 years consistently. It hasn't issued a new share since 2021, although technically in 23 they bought back probably more than all of the shares they've ever issued, right? So that's good news. But again, the cream of the crop right here is this cash flow growth, right? They've almost 10x their cash flow growth over the last 10 years, right? We go back to 2023, 408 million, 2023, 3.13, right? So again, this cash flow growth is utterly crazy. And again, stock prices over the long run will follow this stuff. Free cash flow and that kind of stuff. Again, how much value can a business provide to shareholders, right? And again, when you're consistently growing free cash flow, you're going to grow. It's impossible for it not to happen over the long run, especially when you're paying down debt and you're buying back shares, right? That is value that is coming back to you as a shareholder, right? Another very thing that I just love about this company, right? 1.9% dividend, but again, look at this growth, 16% per year, right? Look at this growth, right? I mean, they actually just started growing it at the end of 2020, right? So it's actually only been about 3 years since they've been growing that dividend, right? But again, every single quarter since then, they've grown it, right? Again, they started out at 73 cents a share. They're up to 1.53, right? So they've doubled the dividend over the last 3 years, right? I mean, if you look at the 3-year growth, that's about what, 33% a year? If you go back 10 years, you would have over a 9% yield on cost on this company, right? What is there not to like about this company, right? Again, just my opinion, do your own due diligence. Obviously, something could go awry. Obviously, that technically is possible, but again, this is just a great company in my opinion, right? Again, solidly priced. Again, it's not overvalued. Again, a problem that a lot of people run into is that they buy good companies, but they pay too much for them, right? Nvidia, good example of this. Tesla, another good example of this, right? Again, you got to be careful. A lot of these companies, yeah, they're good companies, but what is the valuations, right? I mean, this company over the last 20 years up 663%. S&P 188. Let's go back 5 years. Actually, it's about the same. 49 versus 51, right? So actually, no, this one is a little bit more because I can see it went up. It is a little bit more. 3 years. Let's check that out. A little bit more. 1 year. A little bit more. Year to date. A little bit more, right? So again, this company consistently is outperforming the market. And again, that is not even including the dividend, right? When you're including the dividend, it's not even close, right? It's not even close, right? So again, this is, as far as semiconductor companies goes, this is my favorite one at the moment because of that insane growth and nice dividend growth and the valuation, right? You got to keep an eye on the valuation. I mean, if you look at like a Warren Buffett, his most important thing that they're looking at is valuations. They don't care if it's a good company. They don't care about anything. If it's not at a good valuation, they're not going to buy it. And this is a big mistake that so many people make, is that, again, they're buying good companies, but they're paying too much for them. Like I said, Nvidia, Tesla, even the big tech stocks, they're all, in my mind, bordering, if they're not expensive, they're very, very close to it right now. Right? Apple, Google, Amazon, Microsoft for sure. They're all more expensive than you should be paying right now. Right? Again, and it's very easy to figure this stuff out, right? All you got to do, go check the insights here, right? What is the historical range? And again, another important thing too to understand is what is the historical range for comparable companies, right? I mean, the historical 5-year average for a semiconductor company probably is a price or free cash flow of like 30, if I was guessing. Right? So again, not only is this company cheap, I think it's actually fairly cheap, right? I mean, I think fair value is probably at 10 or 20, 30% higher than it is right now. Right? I mean, this company is probably worth at least $100 a share, and it's at 81 right now. Right? I mean, 52-week high is 87. Let's see how high this company got, though. It got up to about 88, right, at the end of 21. So that, in my opinion, that's at least fair value, right? That's the bottom of where the fair value is, in my opinion, right? Obviously, do your own due diligence and whatnot, but I think it's worth at least that much, right? At least that much. And again, if we get a nice bull market, it's going to be companies like this that are going to do very well, right? So. Again, just my 2 cents. Again, I'd love to hear comments, feedback, all that kind of stuff. So, like I say, comment, like, subscribe, all that kind of stuff. And stay tuned for more.